Hello. In this video, we'll be going through the statement of cash flows financing activities. Before we start, just a brief overview of the statement of cash flows. The statement of cash flows is a required financial statement, and it shows all the inflows and outflows of cash that occurred during the period, and it splits it up into three different types of activities. There are the operating activities, investing activities, and financing activities, which we're going to focus on today. So finance activities are any activities that were used to raise capital or pay back capital. So think of, by raising capital, we can either issue long-term debt, like take out a loan or bonds. So think of long-term liabilities, right? So, and then we can, when we pay it back, that's also a cash outflow. Or also, we can also raise capital through the issuance of equity, right? We sell our stock, and in return, we can also buy back our stock, and we also pay dividends on our stock. So any cash inflows having to do with the long-term liability or equity section will go in the financing activities section on your statement of cash flows. So here are just highlighting some of the activities, the types of transactions that occur that impact the financing activities part of the statement of cash flows. When we issue notes payable, or when we repay the principal on the notes payable, when we issue bonds, right, as a way of raising capital, or we're repaying the principal. This is really key, the principal only. And when we issue our own stock or buy back our own stock, and when we pay dividends on our own stock. This slide is just highlighting on interest and dividends specifically. Interest and dividends received from investments that the corporation has are classified as part of the operating cash inflows, because when we recorded that interest that we received or dividend that we received, it would be an interest income or dividend income, and it affects net income, right? Because that income goes on the net income. And anything that affects an income statement is going to go through the operating activities section. If we pay cash for interest, right, whether it be on a loan that we have or a bond that we have issued, think about the entry that you would record when we pay cash for interest. You would debit interest expense and credit cash, right, for whatever amount it is. Well, the interest expense lands on the income statement, and therefore, if it lands on the income statement, it's going to be part of the operating activities section, not financing. So when you think of financing, you just think about when we repay just the principal, back to this slide, when we repay back, it's only a financing activity when we repay the principal on the note or principal on the bonds, right? The face value amount. So, and then when we as a corporation pay dividends on our own stock, think about that entry. We would debit retained earnings, right? When we pay dividends, and credit cash. Well, retained earnings, this is not part of the income statement. It impacts the equity section, the stockholders' equity section. And so therefore it's going to be financing, because anything impacting your long-term liability and equity section is going to go in your financing activity section on the statement of cash flows. Let's go through this concept check. There's selected information from Shiloh Salon accounting records and financial statements for 2027 as follows. And the question asks, on the statement of cash flows, the company should report net cash flows from financing activities of what? So let's take these transactions one by one. The first one is cash paid to retire bonds. Think about what that entry would be. So retire bonds, meaning we're paying them off. So we're going to credit cash, so it's a cash outflow, and we would debit our bonds payable, not notes payable. I'm going to put BP for bonds payable. Well, the bonds payable is a long-term liability, so therefore this is a financing transaction. So the first line is going to be cash paid to retire bonds, and it's a negative because it's an outflow, right? We're paying it off. Then we have treasury stock purchased for cash. So what is it? Think about the entry for this. We purchased treasury stock, so we're going to debit treasury stock, and we would credit cash for $50 for this transaction. Treasury stock is going to be in our stockholders' equity section, and therefore it will be a financing activity, and it's a cash outflow because we're paying it out. So here we're on our next line item, cash paid for treasury stock, -50. Next transaction is proceeds from issuance of stock. What's that entry going to be? It's going to be debit cash and credit common stock, okay, for $70. And whether it's common stock or additional paid in capital, right? It doesn't matter. Both these entries are part of the equity section, and therefore it will be a financing activity, except this time we received cash, so it's a positive, it's an increase to our financing activities. And proceeds from issuance of mortgage bonds, again, we'd be debiting cash and crediting mortgage bonds payable, right? This is a long-term liability, and therefore it's going to be an inflow because we're receiving cash on our financing section. So that's going to be the next line, proceeds from issuance of mortgage bonds, plus 80. Next, cash dividends paid on common stock. Again, think about the entry. We would debit retained earnings, 25, and we paid cash, 25, because it's on our own common stock, right? And so this is the equity section, and so therefore it's going to be financing, and we paid out the cash, right? So it's an outflow, so it's a negative. And then the last one is cash interest paid to bondholders for $15. So when we pay that cash, first of all, we credit cash for $15, and when we pay that interest, let's just assume the interest expense and the payment is the same. We would debit interest expense for $15 and credit cash. We might have also an amortization bond discount or amortization bond premium, right? But we're not going to get into that here. But the interest expense goes on the income statement, and so therefore it's an operating function and doesn't go on the financing activity section. So when we look at our final amount, we have a net cash inflow of $45. And that's what the answer is, B. Okay, so when we prepare our statement of cash flows, we're going to calculate our net cash from operating activities, investing activities, and financing activities. Let's go back into this problem that we've been working with through prior sessions for the operating activity, investing activity sections. This is the same comparative balance sheet. So for every time you prepare the statement of cash flows, you need a comparative balance sheet, which shows you the current year balances and the prior balances, because you're going to have to look at the increase or decrease year over year. And we're going to need our income statement for the current year, plus additional information that's needed to prepare the statement. Now, we have items A through H. A through D we've addressed in the actually in the investing activity video. And items E through H we're going to address here in this video for the financing activities. So let's start with the first one that we're going to hit. It's going to be item G. A note payable with a principal balance of $60 million was repaid. I just want to stop there. A note payable with principal balance. So first, we know it's principal, so we know it's going to be a financing activity, but if you can't remember that, a note payable, we pay off a note payable, that would be a debit to note payable for 60 and a credit for cash for 60. The note payable is a long-term liability, so we know it's a financing activity. And then it says, in addition, interest expense during the year on this note and all other notes payable was paid in full. Well, any interest that's paid on the note goes to interest expense, and therefore that's going to be dealt with in the operating activity section, not in the financing activity. So what you want to do is you want to see that line item on your balance sheet, and here's our notes payable, and we know we we've been told that the notes payable, the principal balance of $60 million was repaid. So that's going to be our first line item on our cash flow, on our financing activities. Repayment of notes payable, cash outflow minus $60 million or $60. Now, let's look at our balances for our notes payable account and roll it forward. We had a beginning balance of $100. We were just told that this note was paid for $60, so we would reduce that balance, right? We would debit notes payable, and our ending balance is $90. That does not flow. There is something missing in here, right? Something else occurred during the year. Let's see if we can find what it is. Back to our additional information, we see item E. It says, land was purchased by issuing a 12% 5-year $50 million note payable to the seller. So here we purchased land, right? So we debited land for $50 million and we credited notes payable for $50 million. So there was no cash that exchange for this particular transaction, but we had an inflow from the investing section and an outflow, an increase in the financing section. This will need to be disclosed on the face of the statement of cash flows for under the non-cash investing and financing transactions. But in any case, we still have to record this entry, right, in our journal ledger. So we have a credit to notes payable of 50, which is an increase to 50. So let's go back to our roll forward. So when we roll forward the 100 plus 50 for the note acquired minus 60, now our ending balance is actually 90. And then we could be assured that we've addressed all the transactions that occurred within this one account. Okay, let's move on. Item F. I just rewrote it right here. Item F. The increase in the common stock account is attributable to the issuance of 10 million shares of common stock. The market price of the $1 par value common stock was $20 per share on the date of the transaction. So you take the 10 million shares times $20 means $200 million. So we received $200 million, okay? So we will have that 200, that plus 200 will come in just in a second. But let's see if our common stock account, what happened to our common stock account. Our common stock account, let's look at it. It went from 100 to 110. It increased by $10 during the year. And that's all attributable to this one transaction on item F, because we sold 10 million shares at $1 par value. That would be, let's see, we received cash for $200 million. And now our common stock is the 10 million times $1 par is 10. Next, to make this entry balance, right, we haven't completed it, is the paid-in capital in excess of par. I'm just going to put paid-in capital, and that's going to be for $190. When we issue the stock, we do the par value to the common stock and the remainder to the paid-in capital excess of par. So when we look at our paid-in capital account, it went from 500 to 690, so it increased by 190. So now this one transaction has all been addressed in this accounts for all the changes within these two accounts. If it didn't, then we would have to look to see what other transactions occurred. But here on our statement of cash flows, we say issuance of common stock 200 plus 200, right? Because we got the cash for it. Lastly, we got item H, and this is in the way. It says cash dividends were paid to shareholders. Okay, but it didn't tell us for how much. So how are we going to figure out how much cash was actually paid to the shareholders? How much do we pay in dividends? Well, we know that the retained earnings roll forward is going to be our beginning retained earnings, 1,550, plus net income, which we get from the income statement. And if you go back, you can see that the net income from the income statement is $120. Minus dividends declared, or in our case, dividends paid is what we should do, equals the retained earnings ending. Now, just want to point out before we move on, this is the roll forward for the retained earnings. You have to reduce retained earnings by dividends declared. But for the statement of cash flows, you only address the dividends in the statement of cash flows if they were actually paid. Because remember, we're only talking cash movement. So just because a dividend was declared does not make it go on the statement of cash flows. It's just once it's paid is when it goes on the statement of cash flows, okay? But now we're going to assume it was all declared and paid in the same year. So here we have unknown, we have to solve for X essentially, and that's going to be $30. So to make this roll forward work. And so when we do that, we can finish our statement of cash flows, payment of dividends, it's an outflow of $30. And then our total is net cash flows from financing activities, $110. The reason why we know we're done is because now we have addressed all the long-term liability accounts, which in our situation was only the notes payable, plus all of our accounts within the stockholders' equity section, which we looked at common stock, paid-in capital, and now we've addressed the retained earnings section portion of it. So our net cash flows from financing is $110. Let's go back to what we need to do when we actually do the statement of cash flows, and we've just kind of condensed it. We had our net cash flow from operating activity, which was all in a prior video, and we had an inflow of $150. Our net cash flows from investing activity, a different video, we had an outflow of $160. And now we know the net cash flow from financing activities is $110. We're going to add all these inflows and outflows, and we get a net increase. So net inflow of $100. The next thing you have to do is you have to look at your balance sheet account and compare the change from prior year, which was $200, to the current year, which was $300. So the change is plus 100, right? Our cash account, when I say cash, it's cash and cash equivalents, but I'm going to call it cash. Our cash account increased by 100, which is exactly what our statement of cash flows shows. So that's how we know that all the inflows and outflows are properly addressed in our statement of cash flows when we do this final check to make sure that the difference between our cash accounts is equal to our net increase or decrease. And then finally, here's the total, the completed statement of cash flows where I have my operating activities and everything listed, my investing activities, my financing, my net cash inflow compared to prior year and current year cash account. And then this is what I was talking about earlier, this disclosure, or it's not a disclosure note, it's on the face of the statement of cash flows for non-cash investing financing activity. And this is where we list the purchase $50 of land for that note.